Well, China's President Xi Jinping, President Obama meeting in Washington this week, and China's currency and the value of it is top of mind for a lot of folks in this country. Fred Bergsten is director of the Peterson Institute for International Economics. He joins us now from Washington. Sir, you've been very outspoken on this issue, testifying in front of Congress at the end of 2010 about just this. What is your take on what message the Chinese president will send our president and what message President Obama will send back to him?
I think President Hu will argue that China has been letting the currency go up since they started to float it a bit again last summer. It's gone up 3% against the dollar since that time. I think President Obama will come back and say that's not nearly enough. You're still running huge trade surpluses. You're disrupting the world economy by taking jobs away from the U.S. and other countries with your big surpluses. You need to rebalance your economy a lot more.
When it comes to how much the Peterson Institute is saying or forecasting that the yuan is undervalued at this point, I know you've said at least 20% in the past. Where do you stand now?
When you look at a trade-weighted average for the Chinese currency, it has not moved at all over the last 6 months, even though they said they would let it go up to start bringing their trade surplus down. So our estimate remains they're undervalued by at least 20% against an average of all of the world's other main currencies, and that means at least 25 to 30% against the dollar.
Let's talk about egos, how much egos are at play here or are not at play. I mean, China clearly not wanting to appear to be or to be bullied into any move.
The Chinese always say that they will never act under foreign pressure. The truth is they act only when there is foreign pressure. They try to disguise that. It would be much better if they would move on their own, pursuing their own interests, which a stronger currency certainly would promote. But the political reality is that they only overcome their domestic opposition to stronger currency when they're under pressure, not just from the U.S., but from the rest of the world. The Europeans, India, Brazil, Mexico, lots of countries are pressing the Chinese now, and I think as a result of that, they will grudgingly and slowly let the currency go up significantly over the next year.
So in the fall, your recommendation to the administration was essentially privately send the message to President Hu that China is now viewed as a currency manipulator. That message is no longer private. I mean, looking at the legislation that some Democrats and Republicans in Congress are pushing, the Currency Exchange Rate Oversight Reform Act of 2011, is legislation the answer? I mean, it looks like you've said the IMF and a coalition of others have to come together.
Yeah, legislation is certainly not the best answer or anything like a complete answer. What the legislation would do is send an unmistakable signal to the Chinese that the U.S. is simply not going to put up any longer with this dramatic undervaluation of their currency. We calculate that the Chinese trade surplus with the world is $300 to $500 billion per year higher because of this undervalued currency. We calculate the U.S. global trade deficit is $50 to $100 billion higher because of the Chinese currency manipulation. And that's taking at least 500,000 jobs out of the U.S. economy and many hundreds of thousands of jobs away from other countries around the world. So it's not just a U.S. problem. It is the world as a whole reacting increasingly to China undervaluing.
You say 500,000 jobs at least have been taken as a result of this. What do you say to those that disagree with you and those that say if we see the value of the yuan rate, increase by, say, 20%, then those jobs will just go to Indonesia, Vietnam, other places where the cost of labor is low?
Well, if China let its currency go to a market-determined level, certainly a lot of jobs would shift to other exporting countries, no doubt about it. But still, there would be a tremendous job creation in this country. First of all, we would export a lot more to China because with 20%, 30% lower prices for our products, they would buy a lot more from the United States. On the import side, some of the jobs would return here, not all of them. Some of them would be reduced imports in total. Some would shift to other suppliers. But a significant fraction, maybe 20%, maybe a quarter, would come back to the United States. The U.S. would only gain something like a quarter of the total trade impact of China's revaluation, but that's an awful lot of jobs for the United States.